If you've made a nice profit along the way, get the hell out. What do you got to lose? A lot more than you have to gain. And especially when markets are at all-time highs and the insiders are selling 6-1, what more do you need to know? And that would be my biggest piece of advice. And everyone is so infatuated with the liquidity is falling. And that's not a good sign either for the banks who are then experiencing all of this stress with delinquencies in the commercial real estate market and an economy where rates are moving higher and liquidity is becoming far harder to come by. This is all, this is kind of a very, very scary economy that he's taking over, one that certainly underneath the covers is not as rosy as the mainstream media, like that guy you read, are making it out to be.
In today's news recap, gold demand in India slows, Lunar New Year fuels interest in other hubs. Gold discounts in India rose this week as consumers refrained from buying as local prices hit a month's high, whereas the upcoming Lunar New Year festival stimulated gold buying activity in other major Asian markets. Indian dealers offered a discount of up to $17 an ounce to official domestic prices, inclusive of 6% import and 3% sales levies, up from the last week's discount of $14 an ounce. Prices are high, so buyers are holding off on purchases. Anyway, the inauspicious Car Mass month in Hindu calendar is still going on, an Ahmedabad-based jeweler said. Jewelers were on the sidelines due to volatility in the Indian rupee and overseas gold prices, said a Mumbai-based bullion dealer with a private bank. International spot gold prices hit 4-week highs this week. In China, the world's top gold consumer, dealers quoted discounts of $2 per ounce to $9 premium on spot rates, down from the premiums of $4.50 to $10 charged last week. The year of the snake approaches, arguably an auspicious year and a perfect backdrop for further gold purchases. Independent analyst Ross Norman said Chinese investors will be encouraged by news that the PBOC have added gold to its reserves for the second month in a row, which may suggest the current price reflects fair value. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your gold and silver gear, from t-shirts to hats, designed by stackers for stackers, premium quality, shipping worldwide. Let us know if you'd like any specific designs, and remember, mine is bigger than yours. Let's get back into the episode.
I'd like to mention, too, in my interview with Judy Shelton, I asked her some tough questions. And I said, what about the gold not being audited? And she says they always come up with these stupid excuses, too expensive and logistically challenging. And she's like, that's hogwash. We're the United States, spend a few $1 million and get it audited. And that's what she would advise. And I asked her about revaluing gold, how Cynthia Loomis, she said she's a big fan of Cynthia Loomis, Senator Loomis from Wyoming, and an advocate for what she's talking about, revaluing gold. She didn't go out and fully say it, but she more or less said, yes, that is a strong possibility, and that they would issue, she believes, on July 4th, 2026, which is the 250-year anniversary, they will issue, Trump will issue 50-year treasuries pegged to gold. And then she said something very interesting as well. She said, and then I could see stable coins being issued backed by the 50-year treasury collared with gold. And this is a woman who could very well be in the Federal Reserve. She was an advisor to Trump. He wanted her to be the head of the Fed. She's very smart. And I think the bottom line is that when I look at everything I see all this talk of crypto and profit and greed and risk on, and the central banks are doubling down on their gold acquisition. Hand over fist. And 45 million ounces of silver delivered off of COMEX, either through flat out delivery or exchange for physical, in the month of December. Who's got that bread? Where's it going? So we're getting to a point where I think these countries, and they're going out of their way to hide it. Saudi Arabia got busted for not reporting it to the IMF. Sorry, we made a mistake. Well, the import-export numbers outed them. Same thing with China. A recent article just came out in Reuters the other day saying that they think that the numbers they've been buying are 10 times understated, 10 times, and that they have never stopped buying all along. When they said they took those few months up, no, they didn't. They just were hiding it and buying it directly from the miners or buying it through the People's Liberation Army. So you see a concerted effort to hide the de-dollarization and to mask it. And after what the BIS did to the BRICS nations at the 12th hour by pulling out of Enbridge, saying we can't work with a country being sanctioned, forgetting that Russia was the R in BRICS, after 4 years of working with these countries to develop it, I don't blame them for being less than forthright. But the one thing that I see through all of this is that the central banks keep buying gold and possessing it, repatriating it. And when I hear someone like Judy Shelton say that's in our future, then I would simply say, especially for those retirees, if you've made a nice profit along the way, get the hell out. What do you got to lose? A lot more than you have to gain. And especially when markets are at all-time highs and the insiders are selling 6-1, what more do you need to know? And that would be my biggest piece of advice. And everyone is so infatuated with risk on. That's the exact time. If you were having a beer with Rick Rule right now, he'd say that's the exact time to move the other direction. And that's what a contrarian does. So one of these times, this broken clock of ours will be right. And even though gold was up 30% this year, it feels like it didn't do anything, right? Because we live in this instant gratification, triple your money in 3-week environment. That's going to hurt a lot of people because that's what they believe investing is. And my whole career, 35 years, says, no, that isn't what investing is. And no, this isn't different this time. I think there's just a lot to be cautious about, truly do.
In today's news recap, UBS stays bullish on gold for 2025 as central banks fuel demand surge. UBS predicts gold's 2025 rally could defy rate cuts and a strong dollar, fueled by central bank demand and economic uncertainty. UBS, the Swiss multinational investment bank and financial services giant, has offered an optimistic outlook on gold for 2025, despite the metal losing some momentum in December following the U.S. Federal Reserve's hawkish stance. During its policy meeting in 2024, gold surged by 27.6%, marking one of its strongest annual performances in over a decade and surpassing the S&P 500's returns. While the Fed's tone caused short-term headwinds, UBS analysts remain confident that gold's upward trajectory can continue into the new year, supported by structural economic factors and ongoing central bank demand. We believe gold can build on its 2024 gains. Although U.S. rates may fall less than expected, they are still on track to decline. UBS's chief investment office highlighted central banks' significant role in driving gold demand. The forecast reflects increasing diversification and de-dollarization trends among global central banks. Despite potential challenges, including fewer anticipated rate cuts and a stronger U.S. dollar, UBS maintained a positive stance. Reflecting the shifting economic environment, UBS lowered its 2025 gold price forecast by $50 per ounce. The bank now projects gold will reach $2,850 an ounce by the end of 2025, down from its previous estimate. Despite this downward adjustment, gold was trading at $2,639 per ounce as of last week, indicating UBS still expects the metal to rise, albeit at a slower pace than initially anticipated. Before we dive into the best clips of the week, don't forget to smash that subscribe button and check out our pinned comment for exclusive VPN offers. Protect your online privacy with NordVPN, the fastest, most reliable service to secure your data and keep prying eyes away. Plus, if you're a stacker looking for truly independent market insights, visit goldsilverstacks.com for the Stacker's Handbook, a comprehensive guide packed with strategies to safeguard your financial future and take control of your wealth. And by popular demand, we've launched our print-on-demand gear for gold and silver stackers. From stylish apparel to unique stacker-themed accessories, it's the perfect way to represent your passion for precious metals. Premium quality, shipping worldwide.
They would. And I want to leave you with two market truisms for those retirees. First one, exponentially rapidly rising or falling markets usually go further in either direction than you think. Almost always do. Their corrections are almost always as brutal as the advances were exhilarating. They don't go sideways. You have a massive upside and it's a brutal correction on the downside. And that's usually how markets work. So be careful of these markets that have gone straight up and have done so well as the insiders are leaving. And the last piece I would leave you with is from Warren Buffett. He says, buy when people are fearful and sell when they are greedy. People are greedy right now. You have the greatest amount of optimism in the stock market and its potential performance. Like over 45% of people say it won't even fall by 10%. That's like record territory. So for all of those people that you asked at the onset, the people that I would care the most about, giving them advice that wouldn't hurt them, the people that right now don't have a chance to make it right because of time, um, you know, profit's not a four-letter word, and get out of harm's way. Do what Zuckerberg is doing, do what Bezos is doing, and get out of harm's way and be glad that you leave the casino a winner. Most people don't. It almost makes you feel like you're insane. And and you look at just the underlying market, you can use it in terms of a military analogy where you have limited participation in the equity market in terms of breadth. It has very narrow breadth, and that indicates limited participation. It also indicates that the chances of a correction or failure are far above average. And if you use a military example, you can say, can the market continue to rally with just a few large caps, call those the generals, leading the way, but the small to mid cap, the troops, the Russell 2000, or was it the Wilshire 5000, these large, broad-based indices, which are a better indication of the entire economy itself, a much larger swath of it, are treading water barely, most underwater. So if you don't have the troops on board, the small caps, the mid caps, where I guess you could say there's value. I got a buddy who runs a hedge fund, and that's where he's putting his money. He says that's the only place that there's real value are the small caps and the mid caps. Well, if they're not on board, the rally has no credibility. And that I think is something very concerning, especially on top of all of the insiders pulling out, including insiders in those magnificent seven. So that's something that to me is very concerning. And I don't care how they try to spin it. You know, great, strong economy, but an economy that is indebted the way that ours is, both on a personal level with record debt, record credit card debt, record mortgage debt, record delinquencies. In the month of December, there was another, I don't know, uh, huge amount. In fact, I can find the number here real quick. Huge amount of commercial real estate delinquencies. Let me see. I wrote it down. Yeah, in the month of December, the delinquency of commercial-backed securities that are securitized, they take these commercial-backed loans and they put it into a mortgage-backed security. The delinquency rate spiked to an all-time high of 11%. And so that's something that we're not used to seeing, right? And so at 11%, that's higher than it was in 2008. This is something that should certainly get the banks very nervous, of course. And I think this is something that the mainstream advisors are ignoring. You talk about the debt ceiling again. The debt ceiling is going to be hit as soon as, well, actually, I think in a week. It's interesting. They set the debt limit at 45 billion in 1939. They've raised it 103 times, and we constantly are outrunning our tax revenue. This is no different. In fact, the first 2 months of the new year for the government, which starts in October, we've already spent more money than ever before in the first 2 months. It's the worst 2 month start to the Treasury in the history of the government. So he's coming into taking over a ship that is taking on water economically. While there's an awful lot to be excited about with his taking office and getting our culture back, it's not going to be smooth sailing for him in the economy. And for people who are at that age now where they can't afford to lose, this is not about return on your money anymore. This should be return of your money and what you need to do to guarantee that. Look, I could say put it into physical gold in your IRA and cash it out and take possession of the metal. Sure, that's kind of, people would say, well, that's self-serving, isn't it? I don't think it's a bad idea. But if I were trying to be diplomatic, I'd say, yeah, cash out all of your stocks that are in positive territory within the IRA, so it's not a taxable event, and then layer nothing more than 6-month treasuries, still paying pretty darn close to 5%, and continue to monitor that, rolling them over, doing things, whatever you need to do to mitigate exposure, not only to the system, but also to the banking system. And I think that's maybe the best advice. And you can do that, several ways. Of course, now you could just cash it all out, pay your taxes. Now that's probably not the best advice, but if you did go directly to treasurydirect.gov, I think the banks are in big trouble. Look, the BTFP is down to basically zero. They aren't making any new loans, and the repo market's basically at zero. The liquidity is falling. And that's not a good sign either for the banks who are then experiencing all of this stress with delinquencies in the commercial real estate market and an economy where rates are moving higher and liquidity is becoming far harder to come by. This is all, this is kind of a very, very scary economy that he's taking over, one that certainly underneath the covers is not as rosy as the mainstream media, like that guy you read, are making it out to be.
What are your thoughts on Andy Schectman's interview? Do you agree with his predictions? Do you think the BRICS nations could challenge the US dollar and disrupt the American economy? Could gold really blow up in 2025? Drop your honest opinions in the comments and let the stacker community know if you're investing in miners or prefer sticking with physical metals. Thanks for watching. Don't forget to check out this video over here. I'm sure you'll enjoy it. I'll see you on the other side.